Japan just crossed a line that hasn't been crossed in 30 years, and the ripple effects are going to destroy unprepared portfolios in the next 90 days.
On January 20th, 2026, Japan's 30-year government bond yield spiked to 3.9%, the highest level since these securities were created in the 1990s.
That might sound boring. That might sound like something happening on the other side of the planet that has nothing to do with you. But here's what happened next that should make your blood run cold. The United States Federal Reserve had to intervene directly in currency markets to prop up the Japanese yen.
That again, the U.S. Central Bank is now using American resources to support a foreign country's currency to prevent a financial contagion from spreading to U.S. markets.
This isn't normal. This isn't routine central bank cooperation. This is panic.
This is the financial equivalent of calling in air support, because the ground troops are about to get overrun.
And if you think this doesn't affect you, if you think this is just some technical bond market issue in Tokyo, you're about to learn a very expensive lesson.
Because what's happening in Japan right now is the beginning of a 20 trillion forced liquidation that's going to hit. US stocks, US bonds, US real estate, and crypto harder than anything we've seen since 2008. In the next 25 minutes, I'm going to show you exactly what's breaking, why it's mathematically unstoppable at this point.
Let me start with the foundation so you understand why this matters.
Japan has a debt to GDP ratio of 250%.
That's not a typo.
Japan owes 2.5 times its entire annual economic output.
Here's what just changed.
In December 2025, the Bank of Japan raised interest rates to 0.75%.
That's still almost nothing by historical standards.
But it's the highest rate Japan has had in 30 years.
And they've signaled they're not done. They've abandoned yield curve control, the policy where they artificially suppressed long-term rates by buying unlimited bonds. They've stopped being the buyer of last resort, and Japanese bond yields have exploded in response.
The 10-year Jap government bond yield has gone from 0.5% to over 2% in less than 6 months.
This is a move so violent, so fast, that statistically it's not supposed to happen.
Bond traders will tell you this is a Six Sigma event, something that should occur once every 100 million years.
But it's happening, and it's accelerating.
Here's where this goes from interesting financial news to this is going to destroy your portfolio.
Japan holds $1.2 trillion in U.S. Treasury bonds.
They are the single largest foreign holder of American government debt.
More than China, more than any European country, $1.22 trillion.
And for the past 30 years, Japanese investors, Japanese banks, Japanese insurance companies, Japanese pension funds, they've been buying. Why? Because it was the greatest trade in the history of finance. It was free money.
I'd like to exchange this yen, please.
Certainly. The exchange rate is currently at 0% for this amount.
Zero cost.
Then you convert those yen to dollars. Then you buy U.S. Treasury bonds paying 4% to 5%.
You collect the spread, 4% to 5% profit with essentially no risk, because you're buying US government debt, the safest asset on earth. This is called the carry trade, and it's been the foundation of global finance for 3 decades.
But the math just broke. Because Japanese government bonds are no longer yielding 0%.
They're now yielding 2% to 3.9% depending on maturity.
Let me ask you a simple question. If you were a Japanese investor, why would you take your yen, convert them to dollars, which creates currency risk, and
send that money to America and buy US Treasuries yielding 4.8% when you can just buy Japanese government bonds at home yielding 3.7% with zero currency risk?
You wouldn't! The risk-adjusted return is gone.
The carry trade is dead.
And that means Japanese investors are going to sell.
They're going to sell hundreds of billions, potentially over $1 trillion of US Treasuries over the next 12 to 24 months as these positions unwind.
That's $1.2 trillion in forced selling pressure on US government debt.
Now you might be thinking, okay, $1.2 trillion sounds like a lot, but the US has $38 trillion in total debt.
We're the biggest economy in the world, and we can absorb that.
And you'd be wrong.
Because it's not just Japanese institutions doing the carry trade.
We close the deal!
Fantastic. Well done.
If you can make 4% to 5% risk-free, what happens if you leverage it 10x? You make 40% to 50%. What if you leverage it 20x? You make 80% to 100% annual returns.
And hedge funds did exactly that. Nobody knows the exact number because hedge funds don't publicly report their positions.
But estimates from major banks suggest the total leveraged carry trade could be 15 trillion to 20 trillion in notional exposure.
Let me repeat that. $15 trillion to 20 trillion in leveraged bets that are now underwater and have to be unwound. We already saw a preview of what this looks like.
In August 2024, when the Bank of Japan surprised markets with a small rate hike, the carry trade started to unwind.
What happened? Bitcoin crashed 23% in 3 days.
The Nasdaq dropped 10%.
The S&P 500 fell 8%.
Over $2 trillion in market value was wiped out in 72 hours.
Just a preview.
And that was just a preview. That was just a small tremor.
What's coming now is the full earthquake, because the rate hikes are bigger, the unwind is larger, and there's no easy way to stop it.
Here's why this destroys your portfolio, even if you've never heard of the carry trade and don't own any Japanese assets.
You own U.S. stocks.
Maybe directly.
Maybe through your 401k or pension fund.
If you have a job and any retirement savings, you almost certainly own Apple, Microsoft, Meta, Google, Amazon, Nvidia.
These tech stocks have been driven higher for years by cheap debt.
Low interest rates made growth stocks incredibly attractive. Companies could borrow at 2% to 3% and invest in expansion.
But when Japanese and hedge fund investors are forced to close their carry trade positions, they don't just sell U.S. bonds.
They sell everything.
They get margin calls.
They dump crypto. They dump commodities.
Sell the silver at 90.
I'm offering gold at a discount, down 50.
We have to liquidate everything now.
Chile. They sell anything liquid to cover their losses. This is indiscriminate forced liquidation. And when trillions of dollar tech stocks get sold not because the companies are failing, but because hedge funds need to raise cash to cover their blown-up carry trades in Japan. Your real estate is at risk because mortgage rates are tied to long-term bond yields.
If Japanese selling pushes U.S. 10-year Treasury yields from 0% to 5.
Housing prices will fall because affordability collapses. Your crypto holdings will get crushed because when institutional money is forced to de-risk,
Bitcoin and Ethereum are the first things sold.
we saw this in August. Bitcoin dropped 23% in days. That will happen again, potentially worse.
And here's the terrifying part that almost nobody is talking about.
According to Bank of America, half of all major institutional money managers currently have zero downside hedges in their portfolios.
Zero protection.
We're going under!
Help us! Somebody help us!
I can't swim. Everyone is on the same side of the boat.
But wait, it gets worse.
Because it's not just Japan.
Europe holds approximately $3 trillion in U.S. Treasury bonds, and
triple what Japan holds.
And Europe is broke. European governments are facing massive pressure to increase defense spending because of the war in Ukraine.
And pressure from the US to spend 3% to 4% of GDP on military.
Where are they going to get that money?
And one of the biggest, most liquid assets European governments and institutions hold is U.S. Treasury
bonds.
And how is the U.S. Treasury responding?
with hope.
Treasury Secretary Scott Bessent was asked about this at Davos.
I've been in touch with my counterpart in Japan. I'm sure they will begin saying things that will calm markets down.
Saying things, not doing things, not implementing solutions, just talking. Saying reassuring words to calm markets. When the Treasury Secretary of the United States is reduced to hoping that Japan will say nice things to make bond markets feel better,
The adults are panicking, and they're out of tools.
Now let me explain something critical that most people, including many financial advisors, don't fully understand.
There's something called correlation breakdown. In normal markets, when stocks go down, bonds go up.
That's how diversification works. You have a 60-40 portfolio, 60% stocks, 40% bonds.
Our portfolios are soaring.
I knew diversification was the key.
Look at that arrow, go up!
The hedge breaks, the correlation flips, and you get destroyed on both sides.
Your stocks fall because of forced liquidation.
Your bonds fall because rates are spiking, and nobody wants to buy government debt at current yields. This is what happened in the UK in 2022, when Liz Truss' government nearly collapsed the gilt market. Stocks and bonds both crash simultaneously.
British pension funds almost went bankrupt.
Your hedge is gone.
Your 60-40 portfolio is now 100% risk.
Both sides are going to move down together. You're not diversified, you're just exposed everywhere.
So what do you actually do? How do you protect yourself when the traditional hedges don't work?
Let me give you the strategy that makes sense based on what's actually happening.
First, understand your
First, understand your current exposure. Go look at your portfolio right now. How much is in stocks? How much is in bonds? How much is in cash?
Dollars. If you're heavily weighted towards stocks and bonds, with no hard asset exposure, you're in danger.
Watch the key levels that signal this crisis is accelerating.
US 30-year Treasury yield above 5%. That's a crisis signal that long-term rates are spiraling.
Yes. Japanese investors are selling dollars and buying yen to bring money home.
Third, defensive positioning. This is not about getting rich. This is about not getting poor.
Sectors and assets that historically hold up or benefit during these crises. Energy, Abels, ExxonMobil, Chevron.
Energy is essential. Demand doesn't disappear. These companies pay dividends and have pricing power.
Materials, specifically gold and silver. GLD for gold, SLV for silver.
Gold is hitting all-time highs right now, for a reason.
When government debt is in crisis and currencies unstable, gold holds value.
Quality technology. Liquidity. Microsoft, Apple, Google, Meta. These companies have fortress balance sheets, generate massive cash flow, and aren't going away. They will survive and likely raise prices through any downturn.
Consumer staples Genfra, Coca-Cola, Procter & Gamble, Walmart. People still need to eat, clean, and buy basics even in a recession. What to avoid? Regional banks and financials. They're sitting on massive unrealized losses on bond portfolios. If rates spike further, more banks fail.
High debt companies. Any company with weak balance sheets and lots of debt refinancing coming due at higher rates, they're going bankrupt.
Consumer discretionary mandates luxury goods, high-end retail.
When people are worried about money, they stop buying $2,000 handbags.
These get slaughtered when rates rise and risk appetite disappears. Fourth, hard asset allocation. This is controversial, but I believe it's essential.
Move a portion of your portfolio, 10% to 20%, into hard assets that aren't someone else's liability.
Physical gold, physical silver, potentially Bitcoin if you understand the risks and volatility.
These are assets that aren't tied to government solvency.
If the bond market breaks and currencies weaken, these will hold value or appreciate. I'm not saying dump everything into gold.
I'm saying allocate enough that if the bond market cracks and the dollar weakens, you have a hedge that actually works.
Fifth, avoid the cash trap. A lot of smart investors are saying, move to cash and wait this out.
I disagree. Cash is going to get destroyed by inflation.
If the Fed has to restart QE to bail out the system when this crisis peaks, they'll print trillions.
The dollar will weaken, inflation will spike. Cash loses purchasing power.
Cash is useful for short-term liquidity, but it's not a long-term safe haven in this environment.
The bottom line is this. Japan's carry trade unwind is not theoretical anymore. It's happening. Japanese bond yields are at 30-year highs. The Fed is intervening in currency markets. U.S. Treasury yields are spiking.
And we're in the early stages of what could be a 15 trillion to 20 trillion forced liquidation. Your portfolio is exposed whether you realize it or not. The traditional 60-40 portfolio won't protect you. The hedge is broken. The next 90 to 180 days are going to determine whether you're positioned correctly or whether you watch your wealth get cut in half.
This isn't about fear. This is about math. The carry trade doesn't work anymore. Japanese investors will sell, hedge funds will unwind, markets will fall, and the only question is whether you see it coming and position accordingly.
It's energy. Always wins.
This analysis helped you understand what's actually happening and why it matters to your money. Subscribe right now and hit notifications.
The next video is going to cover the specific